Hey everybody, this is Jose. How are you, everyone? We are about to get started. Let's have a quick sound check, as always. Quick message on the chat box, a quick hello would do. So I know you hear me well, and therefore we're ready to go. As always, on top of that, a hello message is always very nice to receive for everyone in the session live today. So please go ahead and do that. Thank you so much. We are almost hitting the top of the hour, so it's basically time to begin. How are you, Joe? Good to see you. Very nice. Perfect. Okay, perfect. So let's begin, everyone. Welcome to the session. Today is May-26, 2022. My name is Jose Blasco. This is Options Trading Live. We are going to be looking at the markets, looking at options opportunities, understanding the options markets and how options work, putting trades together, discussing the rationale behind the trades or how the trades are set up, the expiration dates, the contracts, etc., etc. And that's what we're going to do. But before we get started, disclaimers. Please read it carefully. This is important information. You can read it on the upper left side of the corner. It's fairly short, so I'm counting on you to read it completely, please. Thank you very much. Again, as I was saying, for the agenda today, we're going to be trading options. The sequence of our sessions typically is, as you can see on the screen, we normally look at the market environment first to understand what's happening out there. From there, we review trades that we may have running, and from there we look into building new trades or new opportunities. Okay, so that's what we're going to do. How are you, Jeff? It's very good to see you as well. Very good. So as we start, question page, I would like to highlight the URL for you to come in here. Okay, so this is tradewithufos.com/Jose. When you use this URL and you come to this page, you basically can access multiple things. We are working basically on the spreadsheet here to add more documentation of the trades and the opportunities that we analyze. Here, a bit lower in this page, you can subscribe to our technology if you're not yet. But really, the section of this page that I wanted to highlight is the question section here in the bottom part, where you can search for answers that you're looking for. There are many posts and many answers, both coming from our support team as well as comments coming from some of the members of the community. So this is quite rich content. You can certainly do a search and get good information there. But also, if the answer you're looking for is not available, you can always click on the green button to ask a question, and then you would post whichever question you have, and then either members of the community or our support team or both would basically get on top of it and give you an answer. Okay, so keep in mind the URL I just mentioned a moment ago, which is, again, tradewithufos.com/Jose. So you can get to this location is the ideal place to get feedback or answers. Anyway, with that said, we are now going to be moving into Top, our favorite trading platform, especially for options. And we're going to be doing our market analysis. As we said, I'm going to move to SPY, which is the S&P 500 ETF, and begin with analyzing this market and understand what's happening out there. So what's happening out there is that the market today is up by 1.77%, which is indeed a pretty strong move to the upside. Okay, so it's a pretty powerful move to the upside. We can see multiple green UFOs forming here on the 55-minute time frame. The next red UFO is quite far away. So from that point of view, it's indeed looking like the market is going to the moon. But anyway, let's take it easy and analyze market information one at a time to understand the market environment better. Okay, so where are we coming from? So let's take a look at the climate. We are coming from a red climate that just concluded. Statistics suggest that for the red climates, we expect a normal duration of 3 candles. This climate was 5 candles, so it lasted for a little more than what statistics suggest. We've seen that happen in recent times. So again, statistics are a good reference, but it's not obviously something that happens every time. That's why there are statistics. In any case, the behavior of this climate is fairly normal given what was happening before. And from there, we just changed to a blue dot in the climate, which notice that this blue dot is thin. It is not a thick blue dot like the ones we have on the left. It is thin, just like the ones we got here or here or here. That one is also thin. Okay, so what does that mean? Well, that means that we are dealing at this moment in time, even though the move to the upside is very powerful, 1.77% up, it's quite decent. So we are dealing with a non-confirmed climate. So being aggressively directional in one direction or another, in this case to the upside, since the color of the dot is blue, being too aggressively directional in that direction would probably be betting too much on hoping something to happen instead of having more evidence from a statistical point of view that this is more likely going to happen. Okay, so careful with that, not to be overexcited, especially if you have long positions or you want to add long positions to your portfolios. Careful with that, because so far we are still dealing with a non-confirmed climate. Okay, now I have to say, in the favor of this climate, that for the first time we are now seeing that the blue line, I mean, for the first time since a long time, I meant to say, not for the first time ever, but for the first time since a long time, we are now seeing the blue line crossing over above the gray line. The blue line meaning the implied volatility of the calls, the gray line being the real-time implied volatility of the puts. This basically, it's showing us that buyers are available in the marketplace. Okay, so in other words, if this climate confirms and tomorrow we get to see the blue line still above the gray line, so we have buyers in the marketplace and a confirmed climate, and that, my friends, it's actually turning around the market predictions that I was discussing last week, where I was looking at this type of market behavior to potentially be a market where the market is going to push down much more intensively. Maybe not. Maybe not. The importance of this blue line crossing over the gray line it's very significant, and therefore it may turn around and set a new climate to the upside, like it happened at a moment in time, which then it was invalidated by a collection of multiple, red climates. Again, important fundamental news took place during this time, which could be the reason why the buyers went away and now new sellers came in. But again, looking at the markets purely from a technical point of view, this is what we have. Okay, this is what we have. So now, careful, because if we look at the implied volatility of the put versus the implied volatility for the calls intraday, okay, if we look at this intraday, notice how the gray line is above the blue line. So this, what I have on the left, is a 3-day average. So in the last 3 days, as an average, so you can see that some buyers are coming into the market. But if you were to look at it today, while the move is very powerful, actually sellers are entering the market. Okay, and we can see 2.9 calls, 2.9 times more calls traded than puts. That's the meaning of this blue colored 2.9 number. That on top of that is above the volume average for the calls for that particular expiration date. So you would think many calls are being bought, and that's why the market is rallying all the way to 1.77% up. Well, guess what? It's not the case. Those calls are being sold, and that's how the blue line is lower than the gray line, because this huge amount of calls are being sold. So again, we are still in a situation where, at least intraday today, we have sellers coming in. So it's going to be very interesting tomorrow when the climate either remains unconfirmed with a thin blue dot, or the climate changes to a thick blue dot. So that's going to be very interesting to see what is happening with the average implied volatilities as the market reopens tomorrow, because basically, it's going to reveal very much, if the climate is going to change, or the market sentiment, if you wish, is going to change to be bullish, coming from bearish after, let's call it a 20% drop, just rounding numbers here. So it's looking like that we're gonna have this answer very, very soon. Okay, so, but again, today, caution. Okay, why? Because even though we can see blue above the gray, okay, and you may be like, that's it, this is the time. Well, again, careful, the climate is unconfirmed, and on top of that, even more careful, real time, the gray line is above the blue. Okay, so let's not get overexcited, and therefore let's be prudent. Okay, so what do we do in a market environment like that? Well, my favorite approach would be to do non-directional trading. But at the same time, when the market is moving up 1.77%, so what happens to the VIX? It drops. And the VIX is now trading at 27 instead of 30 plus, like it's been in the prior weeks. So, and most importantly, not only is dropping to 27, but it's dropping into areas where there are many green UFOs, which very likely are going to make the VIX to go back up, which, by the way, this also means the market to go down. So, and also, by the way, notice how the S&P is going up by 1.77%, and the VIX is going down by 3% only. Okay, look at that. I'm having a problem there with the background of my camera. Not sure exactly why this happened. Give me a moment, guys. Just give me 1 second if that's okay. Interesting. Interesting. So not sure why this. Maybe since I was talking about the markets are gonna be more bullish, the our video streaming service didn't like the fact that I was using a red background, red color background. Maybe if I had used the blue, this would have not happened. So no idea why this is happening, but again, I think it looks pretty ugly like that. So if you don't, let me turn off the camera in the proper way, because if I turn off the camera this way, then you won't see me. Okay, but now you should be able to hear me. Even though you don't see me with that ugly green screen background that I use when I do the sessions. Anyway, I was saying that as the market is going higher by 1.77%, which is something that should really calm market participants, the VIX is only dropping only 3 point something percent. And that means that the market participants are not really getting that calm. Okay, if they were getting that calm, the prices of options would get much lower. Okay, so we had, for example, we had drops of VIX here going from, what was the closing price the other day? The closing price was 28. So if we look at closing prices, like for example here, the closing price on the day was 29. Okay, so the market went down, and next thing you know, the VIX went down to 25. So from 29 to 25, we're talking about 4 points. Here, the close yesterday was 28, and the current price of the VIX now is 27. So we got $1 drop, which is not a lot, which again, it's obviously in line with what we saw earlier, with the implied volatility of the puts being above the implied volatility of the calls for the S&P. So yeah, again, from a directional point of view, again, we still need to see more evidence to be bullish. Okay, we need to be careful here, but the reality is that options are going down, and while 27 is not a very low value, they are getting into green UFOs, which is likely going to bring this back up. And therefore, my non-directional approach, my favorite way to approach non-directional trading in this particular case, would be to do it using double calendars, so we can exploit trading ranges as we see implied volatility rise again while we collect time decay. Okay, so that's what I would like to do, because doing Iron Condors now, it's not a bad thing to do if you wish, because 27 IV for the VIX, it's not that bad. It's not low. Okay, it's absolutely not low. Not too long ago, we were trading at 18, so 27 is not too bad. But at the same time, with all those green UFOs, so the prediction would kind of be that volatility is more likely going to go higher than lower. And because of that reason, I'd rather do double calendars at this stage instead of doing Iron Condors. Okay, please comment on that or confirm with a quick "I'm with you, Jose" or something like that you are with me. And if you're not, or you have comments, please ask about it, so that way I can clarify what I just said in case it's confusing. Because again, my intention, Josip's intention, all the coaches' intention every time we run the live sessions is that you become self-sufficient, so you can develop the thinking process, you can develop the rule set, you can develop the methods, you can develop yourself, you learn how to use the UFOs, the tools, etc. So you become independent. So then you can basically trade, and you don't need us, okay? Even though of course we certainly enjoy spending time together, isn't it? But the idea is that you become independent, and therefore your questions are important for me to make sure that you are getting what you need. Okay, so let me know, and if it's not a question and it's a confirmation that you are with me, that also helps a lot. Cool. So with all of this said, we're going to move now into reviewing our positions. Okay, I'll start with Verizon. Okay, with Verizon, to be honest, is a trade that it's working very well at this moment in time, surprisingly, because the other day I was mentioning that I was not expecting such a move to happen, given the fact that I was so bearish on the S&P. But the lesson here is that, and we talked about that many times in the past, to be honest, the lesson here is that it's very powerful when we plan our trades and we scan for opportunities when we use the grouping, right? So I normally work on this with the matrix, where I have certain rules on the matrix when looking for stocks which are strong stocks that belong to strong sectors, or weak stocks that belong to weak sectors. I know that in recent times you also have done some very powerful sessions with Josip talking about the grouping, and again, this is a great example of why it's important and why it helps so much, because the S&P has been killed. And again, if I go back to the S&P, the lowest low of the S&P was set on May 20. This is the lowest low, in recent times, May 20. So if we look at Verizon, the lowest low was actually set much before, which was May 2, on May 20. So we were talking about this. That was May 20. So you can see how the S&P was being crushed, but the stock was really resisting the selling pressure in the equity markets, and it was really trying to fight back up. Why? Because that stock belongs to a strong group. Okay, so again, it's very, very powerful, and this is basically now producing a very happy result for our trade. If I bring the real-time result for the trade here, so the trade is currently producing $102 of profitability per contract. Okay, and not only that, there are multiple actions that are going to be very wise for us to exercise on that option. Okay, which I'm going to analyze as we speak by bringing in the risk graph. Okay, so here's the risk graph of Verizon. So again, we can see that based on the midpoint of the options prices, we're making 96.5% dollars per contract. Again, thinkorswim does the math a little bit more generously. It's about the same, really. So $100 per contract. Let's call it $100 per contract. So that's good. We are in the green territory, and of course, if the stock keeps rallying, we're gonna make more. Okay, but what's the risk of the trade? 958. Okay, so if Verizon, instead of continue rallying and get to our red UFO, which is where the target is, I believe the target was 52, if I'm not mistaken. If instead of keep rallying to get to our next UFO, Verizon now goes ahead and drops like strong, next thing you know, we may still lose $950 per contract, even though that stock is proving itself moving nicely in our favor. And we talked about that last week on how it could be very beneficial to work on those puts, to get rid of the puts and therefore get rid of the risk of the trade, and then even to make it even better, sell calls against the call we own. Remember that this trade, okay, maybe I'm assuming with this comment, maybe I'm confusing you if you're watching this recorded. So what this trade is made of is we own a call that was purchased at a higher strike, and to be precise, is the 52.5 call, and below price we sold two times, okay, a put spread, okay, where we sold a put and we bought a put below price 2 times both. Okay, so those puts basically created a credit that was used to purchase the call, and therefore the call was purchased at no price, but it doesn't mean it was purchased at no cost, but it doesn't mean you have no risk. The risk is the distance between the puts times 2 minus the credit, which is 958. So now what happens to the puts when the stock go up? Well, they lose value. So I may be in a position where I can get rid of those puts, meaning buy to close, get rid of the puts, cash in some profit, but most importantly, get rid of the puts. So that means that now the risk of the trade will be none. Okay, so let's go ahead and analyze that possibility. Okay, I'm gonna call my compare spread, and I'm just gonna edit the spread, adding 2 legs, which are gonna be puts. Okay, with 2 units each. Okay, where 1 put is going to be to buy, 1 put is going to be to sell. So the one I want to buy is the one I sold, which is the 45 put. So buy the 45 put to close it. And the one I want to sell is the one I bought, which is the 40. So sell the 40 put right here. And if I do that, then I click OK. So this is now leaving me in a position where the maximum risk is $13. Okay. And the risk profile now, I need you to, I'm just going to use yellow color. Hopefully it works well. I want you to focus on the orange line, which to me is going to be yellow, okay, which is this one. That will be the new risk profile. In other words, all this risk is now back down to $14, $13. Okay, so basically closing those puts now puts us in a very good position from a risk management point of view, knowing that, by the way, if the stock keeps rallying, okay, let me zoom in. Notice how the P&L of the gray line and the blue line is almost the same. Okay? The difference between them, to be honest, is $14. Okay, so you're gonna make the same amount of money minus $14, but now you have no risk. The only risk you have is $14. So it's certainly an action that will make a lot of sense. Okay, but then to make it even better, okay, given the fact that we are very close to the target, what I would suggest to do, apart from closing those puts, is to go ahead and sell one of the 55 call. Let me do it, and then let me explain what that means. Okay, if I sell one of the 55 calls, okay. Oh, and by the way, I did not say that correctly. The risk that we had earlier was minus 14, I believe. So minus risk means no risk. Okay, so I was not paying attention to the minus sign. Let me do that again, just in case I got confused. I'm gonna get rid of the 55 call. Yes, so it's minus 15. Minus 15 means that you have no risk, meaning the worst case is to make $15. It's minus risk. Okay, so it means no risk. Notice on the original trade, we got positive risk of 958, but here minus risk means that worst case you make 15. I did not explain that correctly earlier, and since I didn't zoom in enough to see the fact that the orange line is above the dotted white line, which is the zero line, so I said it backwards. Okay, so sorry about that. Okay, but I guess now it's clarified. Now, what I was saying that I would like to do as well is to sell the 55 call, and I want to explain what's the rationale behind that, because you may be like, oh, that's not too interesting. Well, take a look. If I sell the 55 call, I'm gonna collect additional $24 of credit, or $24 of premium, I should say, making my total credit $39, meaning that now, worst case, I'm gonna make $39 worst case, no matter what. Even if the stock drops to zero and disappears from the world, you're gonna make $39 no matter what. And if the stock rallies to a higher price point, so now you are putting yourself in a position where you can make more. And I'm interested in doing that because of the following. Let me go back to the chart here. So I was looking at the climate, okay? And while I'm looking at the climate, I'm also looking at the implied volatility of the puts and the calls. And I noticed that as this move up was happening, that move up happened because of one reason. There are buyers in the market, and we can see that by seeing the value of the implied volatility of the calls being above the implied volatility of the puts, which was not the case before, as that stock was being crushed. So in other words, we got buyers in the market. Bad news, the climate is extended. 8 out of 4, it's extended. So this climate is set for a pause. So probably we're going to have some sort of a, correction, whatever. But then if we have a new push, okay, potentially we may go higher than 52, which is the target I set for myself, right? So if you were to project from above this pivot point, so we went beyond that. So where's the next pivot point? All the way there, which is kind of like 55. So again, that's very optimistic. But so let's pretend the market falls from where we are now, right? And let's pretend the market falls from where we are now, and of course I cannot. This is very silly of me. I'm trying to draw something if there is no drop, because the projection actually depends on the drop. That's very silly of me. But anyway, you get my point. So if this was to fall, now we have a new high. And if the market does behave as expected, given the fact that now we got buyers on board, and that stock belongs to a strong sector, so now when the market is above this high, probably is going to create a push that is going to go significantly higher than what our current target is. So the fact that we have a bad news with an extended climate becomes a good news, because it actually, funnily enough, opens the door for me to move my target to a further location. And I can do that at no risk. At the same time, I don't want to be that hopeful where now, I think it's going to the moon. So how do I manage this? Well, I'm selling the 55 call. Why? Because basically now, no matter how much higher than 55 it goes, I'm going to make the same amount. So my bet really is that it's just going to keep going. And the moment it gets to 55 or above, I'm just gonna be happy to get out, because that would set my maximum profit. But again, my maximum profit now, so if I bring in the measurements, sorry, I didn't click in the right place. And now, yes, so my maximum profit now would be 288, right? Or worst case, make 38, right? So you are making 3 guaranteed. Worst case, you make 200 plus, where if I was to exit at 52, which is my current target, so at 82, the profitability of my trade would be between 38 to 103, right? So if I get there today, I'm gonna make 38, which is what I would make if I sell the 55 call, because I'm gonna make 38. So it's kind of like the same. But if I was to get to 52, I'm gonna make 100. Where if I'm right and I'm gonna have an extra push and get to 55, I'm gonna make like almost 3 times that. So to me, it's a very good trade management action to do this on Verizon. There is basically no downside or no disadvantage of doing it. The only disadvantage is, if it rallies a bit and gets to 52 and you can make $100 and then it drops and you end up making 39, so you just, give up on $60. But again, having the risk in order to triple your potential profits. So to me, it makes a lot of sense. We got until July 15 to go. Okay, we got until July 15 to go. So certainly we have time. Okay, we have a couple of months. So again, reaching 55 is something that should be doable. And all of those reasons are the reasons for me to suggest closing the puts and selling the 55 call as an efficient way on how to manage this trade. Okay. Joe, why not leave the 40 put? Because the 40 put is the one that is okay. You mean the one that is all the way in the bottom part? Well, okay. You could. If you close it now, you're gonna collect 15 cents for it, right? If you don't close it, you are giving up on 15 cents. So in other words, if the stock falls, instead of making 39, you will make 39 minus 15, which, it's kind of like half. So to me, that option still have value enough to close it, and it's better. Now, of course, you may argue, yeah, but Jose, if I leave it open and the stock just collapses all the way to zero, I'm going to make a lot of money with that 40 put. Yeah, but how likely it is for the stock to be trading below 40 on July 15? Statistics suggest that on July 15 the stock will be here, which is about 45. So for you to go to 40, not only 40, below 40, so probably it would take such a crazy move, which could certainly happen, but it's not likely. Okay, so to me, closing it today makes a lot of sense. Your point about selling it on a down day makes a lot of sense as well, but given the fact that this option is so far out of the money, okay, this 40 put has a very, very low delta, so 4 delta, negative 4 delta. It's a tiny, tiny, tiny amount of delta. So even if Verizon was to drop 2, 3, 5%, you would still be dealing with, maybe instead of 4 delta, you are dealing with 6 delta. So it's just that instead of 15 cents, it's going to be 20 cents. So there is no significant difference. So again, to me, given all the conditions around the trade opportunity in front of us, again, I'm just sharing my way to approach it. Okay, there are a million ways on how to trade. So your points, Joe, are very valid, and the rationale behind your points make a lot of sense. But from an efficiency point of view, my approach to this trade would be just close the puts now, both of them, get rid of them. That's it, done. And then sell the call, and now you're in that easy, relaxed position that may triple your profit, while worst case, you're going to make the same that you're currently making, which is 30 plus. Okay. So that's the approach. So I'm just going to do it. Okay. So how to do that? Well, I'm just going to go to Verizon, select the put. I'm going to deal with that first, and I'm going to go create a closing order for the put. Okay, I'm just going to place at the midpoint of the spread. Hopefully I get filled quickly. And then using the same expiration date on Verizon, which is July, we just got filled at 15 cents. So we're going to sell the 55 call. Also, I'm going to try the midpoint, see if I get filled. Okay, it's waiting there to get filled, and I got filled at 24. Okay, perfect. That's it. I got it. So what do I have now? Well, now I have a long call and a short call, which is a bull call spread. Okay, but it's a bull call spread that I've been paid to get the bull call spread. I've been paid, I think the net would be $39. Okay, so let's document all of this so we can put it on our tracking mechanism. So we close those puts and we bought that call at those particular prices. So for the puts, we got 30 and 15. So 30 is for the 45. Yeah. So 30 and 15. And for the call, we got 24. So the new trade we have is this trade where the net credit is 36, it's not 38, it's 36. Price has moved a bit, okay? And therefore, worst case, we're gonna make 36. Best case, we're gonna make 286, okay? That's the trade that we have. I'm just gonna copy and put that in the positions panel, okay? So hopefully all of this makes sense. If you need any additional clarification, please let me know. But to me, I'm done with this trade. I'm just gonna float it just in case you need me to come back to it. The next trade I would like to discuss with you, which also very interesting trade management approach for this trade, is Lulu. Okay, so let's take a look at Lulu, because this was a trade that moved against us intensively. So let me simulate this trade with a risk graph. Okay, so what do we have in this particular trade? Well, we converted this trade. This was an Aaron Condor originally. Okay, this was an Aaron Condor originally that moved extremely aggressively against us with, like we had no time to wait. It was immediate the move took place against us. This is when the S&P started collapsing very hard. And obviously, we had to act on managements. We had to go all the way when we hit the proper line, even though I didn't do it on that day. I did it the week after. That was last week when we met on this day. So we did convert this trade from an Iron Condor to an Iron Butterfly. Okay, and this gave the trade a second chance to end up with some sort of level of profitability while the risk was reduced. So what is the maximum risk of the trade after doing all those tweaks? 154, which is nice because the original P&L of this trade was not good. Okay, the original P&L of this trade, the original risk of this trade was, I think, 500, close to 500, I believe it was. So we cut it down to 154. So the techniques used to manage a trade were very efficient. But the beauty of what we do, and you can see the effect today, even though expiration is tomorrow, so nothing is a sure thing until tomorrow. But the beauty of this trade is that this trade, let me rephrase that. Converting this trade from Iron Condor to Iron Butterfly not only was diminishing the risk, but also we were giving the trade a second chance. Okay, this is something that in my trading style I love. Okay, and this is something I love about options, which is when a trade goes against you, let's try to find a way to give it a second chance while you reduce the risk. So giving the trade a second chance while you increase the risk, I'm not a fan of that. Okay, so like for example, when you buy a stock, the stock goes against you and you average down and you buy more shares, yeah, for sure. If the stock bounces, you are now giving the stock a second chance, but you are doing it by taking in more risk because now you own more shares. In options trading, we can tweak our methodologies in ways where we reduce the risk from close to 500 to 154 while we give the trade a second chance by varying and moving around the new break-even points. So the break-even points for this trade, as we speak, are 281 to 288. Right now, as you can see, we are still underwater. We are still losing $50, but we are actually within the break-even points. And the theta rate is very, very high. And by the way, this is a distorted theta because with 1 day to expiration, as we know, the grid gets distorted. So it's actually more than that. So in other words, towards the end of the day or beginning of the trading session tomorrow, if the stock is trading more or less around where it is at the moment, we are very likely going to see profitability kicking in. And you don't even need to wait until the day is over to close the trade. You can just close the Iron Butterfly, and we actually may end up in a profit instead of ending up in a loss. Okay, so it's pretty nice. I mean, this has not happened yet. The other thing that would happen is the stock moves very hard either up or down, and you end up with your $154 of loss. But at the same time, great example, great opportunity where the stock went against us. We did what we had to do, reduce the risk, give it a second chance, and now it looks like we may actually end up in a profitable situation. Okay, of course, when these type of situations take place, while it is known in the world of options trading that time decay accelerates as we approach the expiration date. That is true during most of the duration of the contracts, during most of their life. But when we are very, very close to the expiration date, there is this slowdown effect and over or under exaggeration of the theta values on the option chain, which it's the reason why while we are almost hitting expiration date on May 27, which is tomorrow, you can see that while we are within the break-even points, which is here, and here. So we are still showing P&L below the zero line, which is minus 55.5. So you can see that slowing down effect of theta because expression is just way too close. Okay, but what's going to happen tomorrow is when the day starts trading, there is no more time to slow down anything really, so you are, if the stock was to open at 282 where it is trading right now, I'm telling you, we will extremely likely be in the green zone already, and maybe you close this trade for, let's say, $50 of profit or $100 of profit, depending on where it's at. And next thing you know, we basically save a trade that should be a loser into a winner trade. Okay, I mean, technically, you can make up to $846 of profit if the stock is trading exactly at $285 per share, exactly at 4 p.m. on Friday, which is extremely unlikely going to happen. That's why this is a trade to monitor, especially into tomorrow open, certainly today, but especially tomorrow into the market open. And if there is profitability in my set of rules, in my trading style, I would just go ahead and bank it, close the trade, and you're done, and be very happy. Even if you make $20 per contract or you make $100 per contract, be very happy, because this trade should have been a losing trade, and you, thanks to giving it a second chance, you ended up making some money with it. Okay, so if that's the case, just make sure you monitor the trade if you are in this trade. Okay, how many of you are in this trade, by the way? I'd love to know. If you could share on the chat box, that would be nice for me to know. Okay, so what to do here? Nothing, because we are not in a profitable scenario yet. Okay, now, can you place a closing order? Yes, you could. Okay, you could. So if I take Lulu, and I take all those units, and I create a closing order, okay, I will see that for me to close this trade, I need to pay 406. Well, since this trade paid me 346, and for me to get out, I need to pay more, which is 406, then it creates a loss, which is showing here as $54.5 per contract. Right? But what if I was to manage to close this trade for less than 346? Well, if you were to manage to close this trade for less than 346, then you're going to be in a profit. Okay, and you don't know if this is going to happen later in the day, if the market was to move very close to the midpoint to 285, or if this is going to happen right at the open tomorrow, because maybe there is a drop of volatility, the VIX keeps going down for another day, whatever, I don't know. So one very good practice here would be to place an order, okay, to close this, okay, for less than the cost. So if 346 was the credit generated, and I use 346, I'm going to be slightly in the losing side because I pay commissions for all of this. So maybe you go for, 325, right? So anything which is 325 or less, just get out. And now you know that this trade that should have been a loss, now this trade is, next thing you know, is converted into a profit. So you could certainly approach it from this angle. Okay. Now, some of you may be like, yeah, but I would like to collect a bit more profit. So to me, I need at least, 250. So at least, I'm gonna make a bit more from 346 to 250. At least I'm gonna lock in $100, something like that. So if that's the case, that's it. I'll be out. If not, I'll look at it tomorrow and do it manually. So whatever your style is, whatever makes sense, makes sense. So I would say place that order, either day order if you only want this order to be for today, or if you want it to be into tomorrow as well, just leave it as good till cancel. Okay. Out of demonstration, I'm just gonna place it at 2.5. Click and confirm. Of course, I'm not gonna be executed because the current price is 400. So there's no way I'm going to get filled at 2.5 right now, but maybe later in the day, and then we can discuss it on next week. But this is how you would want to manage it at this moment in time, because theta is going to be very, very lazy at this moment in time. That stock may be ranging all day long between 280 to 287. Okay, and you're going to see a P&L similar to what we have now, minus 60, minus something like that. But next thing you know, so theta is going to be very, very lazy. But next thing you know, now the market closes, reopens tomorrow, and you're going to see this dotted line jump into the green area very, very quick. Theta is going to be so accelerated into tomorrow. So maybe you are not around, maybe you get distracted and you missed exiting the trade for a profit. So that's why placing the order as a limit order is great. Also, let's say tomorrow there is this massive crush of volatility and the stock opens gapping up exactly at 285, which is the ideal point where to close the trade. Next thing you know, you may be able to close this trade at $100, right? Which would be a very good profitability, right? So that would be a very, very nice profitability. That would be $200+ of profit per contract. So remember, limit orders get you filled at the price you set or better. So if I set 2.5, but when the market opens tomorrow, the available price at the time is, let's say, 1.1, I will get filled at 1.1. I will not get filled at 2.5. So that price, it's not the price you'll get, it's that or better. And if we have a close and an open in between, so you may get half the price. If tomorrow, again, the stock was to rally up, get closer to 285, time decay kicks in. Because the stock is gapping up, everything gets very calm and implied volatility shrinks by a lot. And next thing you know, you got this amazing exit point. Okay, so the limit order will take care of whatever is better than your 2.5 if that was your price. So this is how I would manage the trade at this moment in time. I would just do nothing but place this order to exit at 2.5 was my choice. Anyway, questions, comments. I'm going to have a sip of water, and I'd love to see you guys typing a little bit on the chat box. I guess I got a little less typing than normal today, which probably means that you guys are with me, everybody's following. But even if that's the case, having some confirmation is really, really useful, important for me, guys. So please, even if it's a quick, I'm with you, Jose, please type that in. Thank you. Cool. So next trade to comment. Down here we have MasterCard. That one is not working in our favor. Okay, so MasterCard is a trade that we identified the other day. That market was trading at this particular price point. At a moment in time, we had a down climate. Okay, it was a down climate on the daily time frame. I believe it was also a down climate on the weekly time frame. So really, the trade looks very good from the setup point of view. But look at that; it absolutely completely went in the opposite direction from the moment we entered. Actually, that was a complete failed trade. Where on top of that, we can now see implied volatility of the calls above the puts. So very, very significant change of sentiment in that particular stock, which is obviously not a good one. Okay, not a good one. Okay, but let's talk about it. Let's understand what is it that we got on our hand. Let's understand what can be done in a situation like that. Of course, the stock has been moving against us for multiple days now, so what I'm going to comment is not ideal to comment it so much later, but again, we haven't met since last Thursday, so this is our first chance to talk about it, okay? Anyway, so what is it that we have here? We have a bear call spread. Okay, that's what we have. We have a bear call spread. So this is a credit trade that gave us $260 of credit, and therefore the most we can make it is $260. And what's the most we can lose? 240. Okay, the most we can lose is 240. So where are we at the moment? We are currently underwater by 122. And because we are above 135, which is our long strike, so as time passes, even though the reputation of credit spreads is that as time passes, you make money on time decay, well, no, because both options are in the money, and therefore your theta, as you can see here, is actually a negative value. It's not positive. So every day that passes, this is worse because you're going to get closer and closer and closer to the maximum risk, which is 240, right? So that's why I said that acting sooner on this trade would have been better, because you would have lost a bit less on time decay, and also the stock would not be so far in the money. Those calls will not be so deep in the money. They will be less deep in the money, and therefore you can act in a way that is more efficient, okay? But what can you do? What can you do? Well, to be honest, the actions that we can take here are various actions, but I would like you to think of credit spread, such as a bear call spread, as something very similar to an iron condor, which is the case we just dealt with Lulu. So an iron condor could be defined in many different ways, but one way to think about it is having a bear call spread above and having a bull put spread below. So in other words, two credit spreads together is an iron condor, if you were to define it this way. Again, there are different styles and ways of think about it. This is certainly a very common way to think about iron condor. So in other words, what I have here is half of a condor. I got half of it. And therefore, I could act on it in a way that is very similar to what I did to the iron condor with Lulu, because it's still a condor family type of trade, if you wish, right? So what did I do to help the Lulu trade? Well, what I did is try to sell options closer to the strikes that were being heard. Well, in this case, which are the strikes that are being heard? 330 and 335. Those were the strikes that were being heard. Okay. So what can we do? Well, try to sell options close to the strikes. And what are my choices? When I said sell options, what are my choices? Well, we own a long, sorry for that. We own a long call and a short call. That's the call spread we have, the 335 okay, call and the 330. That's what we have. So what can we do with this? Well, one action could be to butterfly it, which would be sell another 330 call and buy a 325 call. Now, notice that if I do that, this is a call butterfly. It is not an iron butterfly like what I've done with the iron condor, where I had two calls above, two puts below. Here in this case, I'm dealing with calls all the time. To be honest, and I believe we talked about this in prior lessons, the risk profile of a call butterfly looks like that. The risk profile of a put butterfly looks like that. And the risk profile of an iron butterfly looks like that. So the risk profile is the same. Hey, Ahmed, how are you, my friend? So if instead of selling the 330 call, I do the put, and instead of selling the 325 call, I buy the put, so I'm going to get the same risk profile. Okay, it's going to be the same. So the benefit of doing calls or puts may depend then on having some price anomalies that we sometimes have on certain strikes. I would actually expect that MasterCard not being the most liquid option chain in the world, I would actually expect that we may actually get some price anomalies on some strikes, and we may get a better risk profile, which we're gonna check in a moment. The other thing as well is, especially in a case like MasterCard, where this is not the most liquid stock in the world, so probably I would guess that using puts in this case is going to be more beneficial. Why? Because they're going to be out of the money instead of in the money. Therefore, they're going to be lesser price. And because they're going to be lesser price, typically you would find the bid and the ask price to be narrower. Okay, the spread to be narrower. And that may help you to get a better entry price, because the calls are going to be deep in the money, and therefore they're going to be highly priced, and therefore the spread is maybe wider. So again, all of this is to be simulated because you may have price anomalies, and this could work in your benefit or against you if you don't compare. That's why we have the compare feature in the platform, so we can actually compare. So let's do two comparisons. Okay, I'm gonna prepare two. The one on the top with orange color would be taking the trade I have and use calls against it. So I'm gonna sell buy, which is gonna be sell the 330. Okay, and buy the 325. I'm going to start with those strikes, and then we'll talk about strikes as well, because we may need to do some tweak here. Okay, so if I do that and I click OK, this is the new risk profile I have, where, as you can see, I am accomplishing the typical goal that I'm always looking for, which is reducing the risk. So the risk is now moving from 240 to 132. Okay, and I'm giving the trade a second chance, which is now a new break-even area from 333 to 326, which of course this is now not a directional trade anymore, because before, the more it drops, you make your credit, and the more it drops, it doesn't matter, but the better in a way. Where now, if it drops between 333 to 326, is great, because you're going to be in the middle part of the triangle, so you are profiting. But if it keeps falling and falling and falling, and it falls below 326, actually now you're going to lose the same that if it's rallying above 333. It's an iron condor. It's not an iron condor. Sorry, it's a call butterfly. So being a butterfly is a non-directional strategy, given the strike selection. Okay, and that's the important point, because you could actually trade call butterflies directionally speaking, but in this case, it is a non-directional strategy. So that's why you can see the risk profile. So this, if I'm giving up on the trade, I'm thinking, hey, I'm going to lose. So now, instead of losing 240, you are cutting the risk by half, kind of, by creating a maximum risk of 125. Okay, so this could be an action that could make sense depending on what you see. Certainly the climate is blue, implied volatility of the calls above the implied volatility of the puts. So, again, I will not do it today because if you recall the conversation we had at the beginning of the session where I said we need to wait until tomorrow to see if the S&P is going to be bullish or bearish. So doing this action where you take a bearish trade and you convert it in non-directional, that to me is quite bullish. Okay, and if the S&P becomes blue dot, so then of course I have no problem to do that because I've been proven wrong, and the S&P is likely going to bring the prices even higher. So hey, if I could cut my loss from 240 to 125, perfect trade management, love it. But if the S&P is going to stay as bearish, that means that MasterCard, which is currently trading at 347, may drop again, and next thing you know, this trade, which is currently losing, may now become profitable. So, having this full conversion may not be something I welcome. Okay, but let's continue with the rationale because tomorrow you may want to do this, and then you would understand all your choices. So now, what if we look at the second case with a purple color? So I'm going to add two legs as well. But now instead of using all calls, I'm going to combine calls and puts. Okay, and same story, I'm going to do sell put. And same story, I'm going to be selling the 330. And I'm going to be buying the 325. Okay, but now notice it's puts. It's the same thing, but now it's puts. So what happens if I do this? Well, I get the same risk profile. Okay, but what's my maximum risk now? Well, my maximum risk, as you can see, is 130 instead of 125. So guess what? It seems the call is better, even though if you do the call, you need to deal with $1 full of spread, where if you do the puts, from 570 to 595, you only got 25 cents. So I would rather sacrifice $5 of risk or $7.50 of risk, 132.5 instead of 125, but not be killed on slippage because the puts have much narrower spreads. Okay, so this is the comparison I'm doing. I'm looking at the risk and I'm also looking at the spreads, especially in cases like MasterCard, where these are tradable instruments, but they are not super liquid compared to other stocks, like options on Apple, for example. So this is what I would do, but again, I will not do it today because doing it today, to me, it's very bullish. And before I get that bullish, I would want to see the S&P confirm what we discussed at the beginning of the session. Okay. So what are other alternatives if you want, instead of going from, because this is an extreme kind of management, right? You go from bearish to non-directional. And if you recall my comments when I planned this trade on MasterCard, not only I was bearish, I was very bearish, which I was completely wrong on this trade, right? So going from very bearish to non-directional to me is very extreme. So what are your other choices that are less extreme? Well, your other choices that are less extreme is to work on a different set of strike selection. And you will see what I mean in a moment. So, by the way, I'm going to work on the one that is magenta, which is combining calls and puts because of what we said about the liquidity of the put, the spread size of the put versus the spread size of the calls, okay? So now, if I edit this particular strategy where I become purely non-directional, okay, I'm doing an arrow and butterfly. But instead of utilizing the same distance between 330, 335, 330, 325, I was to vary the distance. For example, from 330 to 325, I got $5 of strike price increment. What if I make it 2.5? What if I make it less? What's going to happen? Take a look. If I make it less, next thing you know, I am reducing the risk, which now drops from 240 to 185. But now I am creating profitability. If the stock chooses to fall, I am creating profitability of $65. It's not like it's a lot, but now at least if the stock is going to fall, I'm going to be able to profit. Meaning I keep the directional bias of the trade to be bearish while I do reduce the risk instead of reducing the risk more. But now I went from directional bearish to non-directional, which again, if you do that tomorrow because the S&P proved itself to be bullish, I'll take it. But if it was to be a trade that you want to do a day like today, where you don't have that information yet, so then given the fact that Mastercard belongs to a weak industry, a weak group, I should say, so I would rather maintain the bearish sentiment of the trade while you're reducing my risk. So this is how you would do it. Basically, you would create an iron butterfly, but instead of being iron butterfly, it would be actually what is technically called as a broken wing iron butterfly, which means the distance between strikes is different on the call and the put side. And that is the reason for the term broken wing. Okay, so this is likely going to be the trade that I'm about to execute in a moment before we complete the session. But before we do that, I also want to show you what happens if instead of going from 327, sorry, from 330 to 325, what if you went below to 322.5? Meaning instead of less distance, more distance. Well, if you were to do that, the risk is that, of course, I'm going to take more risk. So is it going to be justifiable or not? We're going to see the math in a moment. Probably not. Here we go. It's not. It's actually, in this particular case, it's terrible. In cases of strike price increments of $1 at a time, you may find a setup that works. But what I was going to tell you or show you is that now by doing this, even though everything is under the zero line, isn't it? So the only thing that is above the zero line is the triangle. So you still have a triangle, but the profitability to the upside is actually under the zero line. So I was looking to build something. Let me try to draw it so you understand. Okay, I want to use red color just because it's similar to magenta. So I was looking to build something that looks like that. Oh, actually, I didn't change the color. It's fine. I'll do it in blue. And then on the upper side, if the stock goes up, I was looking to build something that looks like that, meaning that there is some profit to the upside. In other words, instead of converting the trade in non-directional, you would convert the trade in directional long. Not directional short, but directional long. So you totally reverse actually the bias of the trade, which I'm not a fan of doing that because first, the stock belongs to a weak group, even though the stock has proven to be very strong, but the stock belongs to a weak group. So that weakness could kick in anytime. So I would not want to be bullish a stock that belongs to a weak industry. Second, which is the second problem, and even worse, which is the fact that the initial risk was 240. Now the current risk is 335, meaning that I have increased my risk. So again, when you deal with stocks with strike price increments of $1 at a time instead of $2.5 at a time, there may be setups, especially in cases where you also have intense changes of implied volatility. So then there may be cases that a stock moves against you, and when you do this type of conversion, you actually end up with an opposite trade. You go from bearish to bullish or vice versa. You do reduce the risk and you make the trade to be profitable on the opposite direction. So those cases could happen. They are rare, but they could happen. In this case, you can see it's not happening. And again, because the stock belongs to a weak industry, I don't want to be bullish anyway. Give me a moment, guys. Sorry about that, guys. I had to drink some water. So because I don't want to be bullish anyway, because the stock belongs to a weak industry, so then my choice on how to manage this particular trade is going to be to use the 327.5 combined with the 330, so I can do this type of approach. Okay. Another way to try to be closer to profitability, and this is going to be the last choice. Okay, it's to sell puts a little higher. So take a look at this. If instead of doing 330, 327, I move everything up by $2.50. So I sell the two. I'm not sure why I'm saying two. Sorry for that. I sell the 332.5, which is $2.5 higher, and I buy the 330, which is $2.5 higher. So if I do that, the P&L now notice that it shows a similar level of profitability, 70, and the risk is 177.5, which to be honest is a bit better than before, isn't it? I was not expecting that one. Let me try that again. So 377.5, 177.5. If I do 330 and I do 327.5, yeah, it's better than 185. It's better than 185 and it's better than 65. So it's actually a better choice. Funnily enough, I guess we picked up a little bit of price anomaly in one of those strikes, which is improving. So if I do 332.5 and 330 is actually a better combination. What if I do 335, 332.5? This is probably overdoing it. Let me see. And it's still providing actually 75. Yeah, so it's still a bit better. 75 and 175, which is less than 177.5. So it's looking a bit better. But now it looks to me I'm hurting my break-even point, which is 330.75 versus the prior case was. So we got 330.75 and the prior case was 333. Okay, so here you would profit below 333, where in the prior case it was 330. Okay, so that was not a good one. What about if I go back to the original one, which is 330, 327.5, which is the broken wing iron butterfly? So that break even of 333 becomes still 333. Okay, so guess what? I guess we are benefiting a little bit of some price anomaly in one of those two strikes. So that's going to be my choice to do 332.5 and 330 to get that 333 break-even point and get that reduced risk from 240 to 175 and get that potential for profitability at up to $75. So let me do that. And I'm also looking at the time. It's time to conclude the session. So we'll just do this as our last step for today. So MA, we are looking at, I think it was June expiration, isn't it? Yes. And we're going to be looking at 332.5 put to sell and 330 put to buy. Okay, 332.5 to sell, 330 to buy. Let me confirm this is the case. Sell 332.5, buy 330. Yes, correct. So let's do it. I'm just gonna confirm and send because it's the top of the hour. If I don't get filled, I'm gonna change this to a market order, which is the one thing I always tell you, never do that. I'm just gonna do it so I can get the prices into the system so we can talk about this trade in the future. Okay, and if you had done that days ago, the lower the price was days ago, the more expensive the puts. So you would have got more than 55 cents. Is that making sense? Again, I'm doing this trade management too late, but the method is what matters. Hopefully you learn from it and you can replicate this yourself. So I'm gonna document these prices properly. So for the 332.5, I got 610. And for the other one, I got 555. Therefore, the real scenario is actually a risk of 185, okay, with a maximum profit of 65, okay? So that's the real, after being filled, of course, with a market order, that's where we're at with this particular trade. And again, very important trade management actions. We often spend a lot of time talking about trade management, and hopefully throughout the time as we are attending sessions together, you guys realize the importance of this, okay? Because, converting a losing trade into a much less losing trade, or converting a losing trade into a profitable trade, or converting a profitable trade into a guaranteed profitable trade, all of those actions are extremely beneficial to the traders. And hopefully you guys got this well understood. And today I didn't get any new trade in. You understand the importance of it, and you've learned new things today. Very good, everybody. So hey, thank you for joining me today. As always, always my pleasure. I will see you soon again. Sorry for the video stream. Got this issue with whatever. But I had to interrupt the video stream, so you cannot see me. But hopefully the session again was good, and you learned good stuff. So I will see you in the next one, which I believe is going to be next week. Take care, my friends. Bye bye. Trade well. See you soon.